So it's a brand new year. 2022 has arrived. Time really flies. So I'd like to start by wishing you a very happy, very successful, and very profitable year ahead. And before we get into the market analysis, let's begin with the year in review. What happened in 2021? What can we learn from it? And what should we expect in 2022? So starting off with the US markets, the S&P 500, the main index of the US, closed the year at 26.89%, which is a very, very high return historically. So as you guys know, historically in the last 100 years, the S&P typically returns on average about 8 to 10% a year. So 26% is really way above, more than 2 standard deviations above the mean. So it was a very, very bullish year. So what drove the market in 2021? Well, number one was again very low interest rates. And interest rates were slashed during the COVID pandemic of 2020, so interest rates remained really low at near 0%. Number two was strong earnings growth, although the growth was off a very low base in 2020. So for example, in quarter one, the S&P 500 companies, their earnings in total grew 52.8%. Quarter two, earnings grew at 92%. Quarter three, earnings grew at 39.9%. And of course, quarter four is not out yet. It will be reported later this month, all right? As far as the overall economy was concerned, the economy grew, of course, helped by a lot of the fiscal and monetary stimulus by the US government. Quarter one, we had real GDP growth of 6.3%. Quarter two, 6.7%, and quarter three, 2.3%. And throughout the entire year, the S&P 500 remained on a very, very clear uptrend. As you can see, the 50 moving average remained above the 150, the blue line above the green line, and prices remained above the 200 moving average. So throughout the entire year, the bull run, the uptrend was very much intact, and it was a no-brainer simply buying on the dip. You always want to buy it on a dip when the uptrend is very, very clear. Now, we had a total of about 10 corrections during this uptrend in 2021. So more than usual, but the corrections were very minor corrections. Most of the corrections were under 5%. So we had the first correction, the second one, the third one, the fourth, the fifth, the sixth, the seventh, the eighth correction was a bit bigger. There was about like over 5%, but still less than 10% correction. Then we had the ninth correction, and the last correction happened somewhere in October. And of course, what caused the correction is not really important because we know that markets don't go up in a straight line. They always go through wave up, wave down, wave up, wave down. But if you read the news headlines, you get freaked out because they'll give you all the reasons why the market went down, which is not important. The important thing is when it goes down, to support, you just add shares. Very simple. But you can see these were the news headlines that dominated 2021. So the first major correction over here started because of soaring treasury yields, where yields went from below 1%, the 10-year treasury yield went to 1.75%. So that freaked people out and caused a big sell-off in the tech stocks. And then you had a very hot inflation rising above 4.5% at this point. And then we had the Fed beginning to say, hey, you know what? We're going to start tapering our bond purchases. We're going to start reducing the quantitative easing or the money printing. And then we had the Delta variant somewhere in July. And then we had the Evergrande crisis from China. And then we had another inflation scare back in October where inflation went above 5%. And we had another one where, again, Omicron dominated the headlines. So, every year you always have bad news. And instead of getting freaked out and getting worried, the bad news is the best time to add shares when prices retrace to support levels. So let's take a closer look at where this gain has mainly come from. So breaking down the S&P 500 into its sectors, you can see that for 2021, the best performing sector was energy, the energy sector, which gained 36%. The second best sector was real estate, that gained 28.1%. And you guys know that in my portfolio, I've got zero exposure to energy and real estate. Okay. Why? Because in the long run, energy and real estate, they tend to underperform the S&P 500 because most of the companies in these two sectors, they tend to be very competitive, right? In the energy sector, there are many companies competing. Same thing in real estate. So with high competition, you've got low profit margins. These companies are very cyclical. Cash flows and revenues are not very predictable. And so I tend to avoid these two sectors because, again, in the long run, you can see, for example, over the last 5 years, if you take a longer term time frame, real estate and energy tend to underperform the overall market. But they were the best performers in 2021 because they were the worst performers in 2020, right? Because of the COVID pandemic. So, in other words, the reason they did so well in 2021 was because they were merely rebounding and recovering from really crappy low bases in 2020. All right, so you can see that again, a lot of the gains came from these two sectors that were recovering. Now, technology, which again, most of my stocks are in technology companies, the profitable ones, that was the third best performer, followed by financials, communication services, industrials, basic materials, and so on and so forth. So the ones in red are basically the sectors which I am more heavily invested in. So my portfolio consists, as you guys know, mainly in technology, financial services, communications, healthcare, and consumer cyclicals or consumer discretionary. Because in the long run, these are the sectors that tend to outperform the market because the companies tend to have higher profit margins, they tend to be in secular growth industries, and they tend to have stronger economic moats. Now, what is interesting to note is that if you look at the S&P 500, it's made up of 500 companies. Now, the 500 companies are not equal in size. We call it the market cap. And you can see that in the S&P 500, about 22% or close to 23% of the S&P 500 is made up of only 5 companies. These 5 companies are so huge, they make up 23% of the whole S&P 500 in terms of the weightage. So what are the 5 companies? You've got Apple, Microsoft, Alphabet, Amazon, and Meta. Okay, and out of all this, you know that I own all of them except Apple, which I want to own, but it's been too expensive for me to add shares. But once shares get cheap, hopefully I want to get back into Apple as well. All right, so a lot of it is again driven by these companies. So mainly what drove the S&P 500 for 2021 was energy, real estate, and the rest of it were these 5 companies, and that's it. So that's what mainly drove the S&P. So here's the thing. In your portfolio, if you don't own these 5 companies, if you don't own energy and real estate, chances are you did not get much gains in 2021 because most of the gains again came from those sectors. How did the other indexes do? So the S&P gained 26.9%. The NASDAQ, which usually outperforms the S&P, rarely for this year, it underperformed the S&P because again, tech stocks did not grow as much as the cyclical stocks that were rebounding off that weak base, energy and real estate and financials, right? So the NASDAQ gained 21% and the Dow gained 18.7%. But again, all 3 indexes ended the year with double-digit returns, which are very bullish nonetheless. If you again take a look at the sectors, these are the exact percentage gains. Energy gained 47%, real estate gained 42%, followed by technology 33%, financials 32%, materials 25%, and so on and so forth, right? The Russell 2000, which measures the small companies, gained 13%. So another interesting thing is that for small caps, have been underperforming large caps in the last year or so. All right. So there's a bit of a divergence. So I expect that in the next year or so, small caps may catch up to large caps. So could look at the small cap ETF, which you guys know that I've been looking at it as well. Now, China really underperformed in 2021. The Hang Seng Index that has most of the Chinese tech stocks like Alibaba and JD and Meituan lost 6.81% for 2021. And again, it currently remains on a downtrend. So downtrend, chances are we're going to keep going down until we see a reversal in the trend. Okay. The mainland Chinese stocks have been a lot stronger. Now, before that, again, although you can see the Hang Seng on the daily candles remain on a downtrend, so it's still bearish short term. But again, if you take a look at the longer term chart on monthly candles, you can see that, right, this is the big drawdown that we had in 2021. We still are above this very strong support at the 200 moving average on monthly candles. So there's a pretty good chance that although short term we are still bearish, we're still on a downtrend on the Hang Seng, but if this support holds, and again we have got policy changes from the Chinese government, because a lot of it is driven by the sentiment from the government, right? Because again, fundamentally, the Chinese stocks are cheap. They are really, really cheap. But again, doesn't matter how cheap, they can get cheaper if sentiment continues to be bearish. Okay, but once sentiment changes, it will change eventually. It will change eventually. The question is when, no one knows when. But once it changes, you're going to get a pretty strong rebound back up. All right, so a lot of gains to be made, but you need patience. You need to be patient to wait for that sentiment to shift. Now, in terms of the mainland China shares, we're looking at the Shanghai Composite Index. Interestingly enough, it's not been hit as hard by the government intervention. So it still clocked the year up 4.7%, although again, it's very low relative to the US markets of double-digit gains. And again, China had a lot of problems this year, or last year, right? You had the Evergrande crisis, you had the energy crisis, you had the Chinese government crackdown, you had a lot of things that were not going their way. You had a slowdown in consumer spending, right? So despite all that, the Shanghai remained on an uptrend, clocked 4.7% for 2021. So how did I do? My main US portfolio gained 23.62% for the year. And you can see that my biggest drawdown for the year was 13.04%. That was, I think, somewhere in March, during the March sell-off, the 13% sell-off here, all right? So you can see that the blue line is the S&P 500 and the green line is my portfolio performance. And so you can see that for this year, I underperformed the S&P 500, but I outperformed the Dow Jones and the Nasdaq and the Chinese markets, right? You may say that's not very good. Well, it's okay. Can't really complain. So what's the reason I underperformed the S&P 500 this year? There are two main reasons. The first reason is because, as you guys know, 20% of my portfolio are in Chinese stocks. And the Chinese stocks I bought, the tech stocks, mainly went down 30-40%. So that really dragged down the performance of my portfolio. And that's the first reason. Second reason is because, again, I've got zero exposure to energy and real estate stocks. And because these two stocks were the best performing sectors in 2021, and I have no exposure to those two sectors, and hence that's why I underperformed the S&P 500. So in the short term, there's no way to predict which sectors will be very bullish and which sectors will be bearish on any given year, and which markets will outperform and which markets will underperform. Like, I had no idea that China would underperform in 2021. I had no idea that the Chinese stocks I bought would be whacked by all these negative sentiment. I had no idea that energy, and real estate would be the best performers. So again, understand that as an investor, no matter how good you are, you can't predict the short-term price movement. You can't predict for certainty which ones would go up and which ones would go down in the short term. But again, as investors, that's not our job. Our job, again, is not to predict the short-term direction of the stock market or of individual stocks, because we can't predict for certainty. Our job is to just ensure that we keep buying and adding great companies that are undervalued. As long as you hold great companies that are undervalued, over the long run, you will beat the market. So for example, you can see that in the last 3 years, which is a longer horizon, I got 162% return, which is this blue line, versus the S&P 500. So very confident that I'll continue to beat the S&P over the long run. But again, in the short term, anything can happen. So we'll see what happens in 2022. Fingers crossed. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.